Welcome to Bunnex Investment Group. In this video, we are going to talk about an easy setup that any trader can follow and make lots of money out of it, provided they put in the patience and discipline for that particular setup. So we'll go through everything you need to know pertaining the entry points of this golden trade setup. But before we go through, make sure you subscribe to this channel if you haven't done so, as well as checking the notification bell icon so that you won't miss any of our content as we upload. So we are going to explain this in 4 parts. We are going to start on peak formations, explain what these are and how they actually forms on the charts. Then the required EMAs. These are the basic indicators that we require for this particular golden trade setup. Then entry anticipation, the point exactly that we need to actually prepare ourselves to enter the market. This is actually one of the most important topics in this video, and you need to watch it for you to understand how to spot these golden trade setups. Then the last but not least, which is also fundamental to understanding and comprehending this whole video, is a chart example that we will do for on one chart. So the first topic, as shown on the outline, is the peak formations. And for this video, we are not going to delve deep in counting of levels, which is mostly taught on this channel. If you do not understand the concept of levels, you may check out our older videos. So basically, levels are impulsive rises or drops. Actually, they are rise on charts as surges of demand or supply of a particular currency due to the amount of contracts that would have injected by the market makers. So we trade the institutional market maker method, and you can actually go back to understand it in much detail. So with this being said, at level 3 we expect to see a market reversal, right? So if ever we have level 1, level 2 and level 3, we reach a point of reversal, and this is the point that we call a peak. So depending on the market context, a peak can either be called a PFL or peak formation low. Like in this context, we have this as the peak formation low, and if it is in a downward context, we'll actually reach a point, will actually come from a point called the peak formation high or PFH. So from these peaks, we shift away from peaks with a very fast move, indicating involvement of the market makers. So at peaks, although some traders love to trade from the peaks, they are actually points of high risk. Why? Because the market makers have all the room to actually manipulate the markets. So I actually advise not to get your entries from these peaks, because in some cases you'd see that they issue a very beautiful reversal pattern like an M, but later they'll do like this to actually grab all your orders before they go away. So to remove that subject, risk, because I would say we are not in a 5 out of 10 business. We are in a 9 out of 10, 8 out of 10, 7 out of 10. And to remove this risk, we'll actually trade away from the peaks. So our golden pattern is expected when these market makers book their initial contracts, right? So whenever they actually reach a reversal point, the PFL or PFH, they actually shift the market with very, very powerful, vehement move, and then later book their initial contracts. That will result in a pullback or a surge of the demand of a particular currency pair in their pairing. So before we continue, to fully understand the institutional market maker method, you need to get the full course. We have a streamlined, straight to the point, which is going to for $99, and see more details via the link that I've left in the description box below, so that you may actually enhance your knowledge on this particular subject. So the next topic is the required EMAs. So if you follow this channel, you know our common EMAs. They are not there to help us predict the market, but to smoothen out how price moves. We use the EMA 5, 13, 50, 200, and 800. And I've seen a lot of comments, even after I define the EMAs, someone would actually say, what is the EMAs? These EMAs are exponential moving averages applied to close. So it's period 5, 13, 50, 200, and 800. Then entry anticipation. This is the most important part of this video. We mentioned that from peaks, market makers are in drive. They have open contracts when we are coming from peaks. So when they book their initial positions or contracts, usually the market will pull back because of the reduced demand or supply of a particular currency. So after we come from a peak, right, the market makers will be in drive. They will be actually having open positions, and with that it will be shifting, or it will be actually increasing, in this case, the demand of the best currency, right? So after they close or book some of their positions, would see the market actually pulling back. So the fifth EMA is a base where we expect market rejection and trend continuation. So we expect to see a pullback that will be terminated at the 50 EMA, and then the market actually continues. So this doesn't matter on which time frame it occurs. It all depends if you are an intraday trader or a swing trader. If you're a swing trader, you may actually take these particular positions, the rejection trades, on the 50 EMA. So the golden trade setup is basically the 50 EMA rejection trade and trend continuation. These trades fail, if I can say, they are actually 90 to 95% accurate if done properly. And it should be noted that the market will retest the 50 EMA several times, but the rightful times are from defined peaks. If you open your chart, you are definitely going to see the market retesting the 50 EMA several times, but it's not always that you need to respect. You only respect when we are coming from a valid peak. And what did I say? A valid peak is a peak that is a PFH or a PFL. And we determine those PFH and PFLs from counting of levels. So let's go over the charts to actually have an example of everything that we were talking about. All right, so in this case, we are on Euro against Japanese yen. I'm going to use the H1 time frame for illustration's sake, and on that, I'm just going to mark some levels. In this case, we can see we had level 1. Let me alter this. It was level 1, right, which was the first impulsive rise, the second impulsive rise, and some consolidation, and we had the last impulsive rise. So this was actually a peak formation high that was determined from the higher time frames. I haven't gone to the H4 and so forth. So this was a peak formation high from the higher time frames. So after determining that it is a peak formation high, the next thing is now for us to wait and see a peak locking, right? A peak locking is basically a 1350 EMA crossover, right? So in this case, a peak actually locked at this point. After locking, we were now looking for rejection of the 50 EMA. In my case, my 50 is the one in blue and my 13 is the one in red. So we can actually see that our rejection actually occurred at this point. We had price rejection of the 50 EMA at this point. Therefore, we had our first entry right there. So it's an entry that was going to be ended at the peak formation low. Therefore, we had a peak formation low at this point, right? So we have said the first thing is actually to validate the peaks by counting of levels. In this case, we had 1, 2, and 3, and we reached the peak formation low. A reset was actually given at this point. We had this reset. The next thing was now to look for a rejection on the 50 EMA. Unfortunately, I wouldn't want to have a rejection at this point. Of course, it was a perfect point of entry since it was a rejection of the 50 EMA after a peak had logged at this point. But in this case, we can see that we had level 1, level 2, and we were now actually in a zone of danger since it was now level 3, right? So in that case, we can safely say that this is a peak formation low. It's a valid peak formation low from the counting of levels. And as I said, we are not going to delve much into counting of levels. So we had 1, 2 correct trades, and now we are waiting. Since this is a quick peak formation low, we can actually say we are now expecting a buy, right? So from that, we had a peak lock, right? A peak lock with 1850 crossed at that point. Then from that, we had this. It was an attempted rejection. We could actually enter this point, or we could actually wait to see a proper 50 EMA rejection, which is this one, right? So it was a very good trade that actually played out very well. From there, we had a beautiful trade in the past week, which was this one. Why did we take this trade as a very beautiful one? It is because this was a valid peak, right? So this is the point that I was saying. You can see this script above. It was actually there to take orders or to take the liquidity that was available in this zone before they shifted the markets. So that is why I was saying it's better off to take these positions. If you can see this small point that we have back tested, you can see that it was highly accurate. We had an entry point here, an entry point, and these entry points can be I would mark them like this below candle closure, below the 13 EMA, right? And another one, let me change this color so that it will be clearly visible. It was a buy, so I'll put a green line. So it was this line. So you had 1, 2, 3, 4 beautiful trades that you could actually take, and you were in the money. So you may try out this before you apply on real markets so that you'd see if it is actually conducive for you. On that note, we come to the end of this video. Check out our advanced course. I've left the link in the description box below. See you on the next one.